Hello, aspiring investors. Welcome back to our channel. Are you excited to make your money work for you but feel that you're held back because you don't have a lot to start with? Well, we've got good news for you. You don't need a fortune to begin your investing journey. In today's video, we're going to dive into 6 effective ways to help you start investing with little money. We'll uncover some strategic tips and tricks to help you kickstart your journey to financial freedom, regardless of how much money you're starting with. So, whether you've got $100, $1,000, or just a piggy bank full of change, this video is for you. Don't forget to hit that subscribe button and ring the bell to stay updated on all our finance and investing tips. Let's dive in and get your money growing. Number 1. Cookie jar approach. Investing and saving money go hand in hand. You must first save money before investing it. You can take very tiny steps to complete it, and it will take much less time than you anticipate. You can begin saving if you've never done so by setting aside just $10 each week. Although it might not seem like much, that adds up to more than $500 in a year. Try stashing $10 in a shoebox, an envelope, a cookie jar, a small safe, or even that venerable bank of last resort. Even though it may seem foolish, this is frequently a crucial initial action. Make it a point to live a little bit below your means and save the difference in a secure location. High-interest savings accounts, which are distinct from your checking account, are the cookie jar's computerized equivalent. If you require the money, you can withdraw it in 2 business days, but it is not connected to your debit card. Once the hoard has grown sufficiently, you can withdraw it and transfer it to some legitimate investment instruments. Number 2. Your employer's retirement plan. Even the straightforward process of enrolling in your employment retirement plan may seem out of your price range if you're on a limited budget. However, it is possible to start contributing to an employer-sponsored retirement plan with sums that are so little that you won't even realize them. Consider contributing only 1% of your salary to the company plan, as an example. That modest of a donation won't likely even be seen by you, but it won't matter because the tax break you'll receive will reduce it even further. Once you've agreed to contribute 1% annually, you can gradually increase it. For instance, you could boost your contribution to 2% of your earnings in year 2. You can boost your contribution to 3% of your pay in year 3, and so forth. You won't even notice the extra contribution if you time the hikes with your annual wage rise. Therefore, if your pay increases by 2%, you will effectively split the increase between your checking account and retirement plan. And if your employer matches your contribution, the situation will be even better. Number 3. Robo-advisor. About 10 years ago, robo-advisors began to appear on the financial scene, simplifying and opening up the world of investing. No prior investment experience is necessary because robo-advisors eliminate all uncertainty in investing. Robo-advisors invest your money in a highly diversified, low-cost portfolio of index funds, mutual funds, or bond funds after asking you a few straightforward questions to identify your aim and risk tolerance. Then, robo-advisors employ computers to regularly adjust your portfolio and make it tax efficient. There isn't a simpler method to begin investing for the long term. The majority of robo-advisors start with relatively little capital and offer reasonable fees based on the size of your account. All provide automated investing programs to aid in increasing your balance. Cost is the one drawback of robo-advisors, if any. The annual fee for robo-advisors is a modest portion of your balance. 0.25% is roughly what the industry average is. Therefore, if you invest $10,000, your annual payment will be $25. That's not a lot of money, but if you reach hundreds of thousands, it starts to add up. It's crucial to remember that the costs charged by exchange-traded funds, which robo-advisors purchase to build your portfolio, are in addition to the fees charged by robo-advisors. By creating your own portfolio of ETFs or mutual funds, you can avoid paying the robo-advisor fees. But for the overwhelming majority of investors, that means a lot more effort and responsibility. Number 4. Invest for the long term. Putting aside a tiny sum each month for investment may not seem important. However, if you had spent 20 or 30 years, you may have amassed a sizable fortune. You can afford to accept greater risk if you plan to keep your money invested for decades as opposed to someone who might need to retrieve their money in the near future. The best time to invest is over the long term. The longer your investment horizon, you will have more time to ride out the tough times as prices tend to recover. A fantastic method to achieve this is by investing in a pension, as they are eligible for government tax breaks and, in the case of employment pension plans, additional employer contributions. Number 5. Open a high-yield savings account. Many savings accounts currently yield around 4% interest on deposits, but if you don't mind locking your money up for several months or even years, you might be able to get a better deal. Regular saver accounts often offer the best rates, but they frequently come with requirements, such setting aside a particular amount each month. Number 6. Mitigate your risk. Don't put all your eggs in one basket by diversifying your holdings. Spreading your money across several asset classes, market segments, and nations is required. This can smooth out any pricing alterations and mitigate risks of loss. We hope this guide helps you all in investing money, whether you are just starting investing or are trying to be better at it. Don't forget to like, subscribe to our channel, and ring the notification bell. Share your thoughts in the comments below. Thanks for watching.